Morgan Stanley is rolling out crypto trading through E-Trade, but the serious competitor to crypto exchanges is not exactly what it looks like. On the surface, this appears to be a bank opening the door to Bitcoin, Ether, and Solana inside a familiar brokerage app. The more interesting part sits underneath that surface, because the trades are powered through Zero Hash, a digital asset infrastructure provider, rather than Morgan Stanley simply becoming a crypto exchange overnight. That detail changes the story from adoption to architecture, and it points toward a quieter battle over who owns the customer, the interface, and the rails underneath. Morgan Stanley's E-Trade crypto rollout is easy to explain in one sentence, but too easy to misunderstand. The offering is in pilot mode, with E-Trade clients gaining access to spot trading in Bitcoin, Ether, and Solana, and recent reporting says the fee is 50 basis points on the dollar value of each transaction. That immediately makes the headline sound like a price war, especially when Schwab has described its own spot crypto pricing at 75 basis points. The first reaction is simple. Another major financial platform is entering crypto and undercutting some competitors on fees. But that reaction gets comfortable too quickly. The unusual part is not that Morgan Stanley wants crypto access on E-Trade. The unusual part is that the customer enters through a major brokerage, while the digital asset transaction and custody relationship sits with Zero Hash underneath. Before calling this a bank takeover or dismissing it as a simple pilot, that split has to be understood. A regular investor may only see a familiar E-Trade screen. They see a quote, an order ticket, and a position next to the rest of their portfolio. Underneath, however, the crypto transaction is not identical to a normal stock trade. E-Trade's own materials describe a separate non-brokerage digital asset account with Zero Hash for transactions and custody. The user sees a normal brokerage experience, but the transaction is actually split between a familiar front end and a specialized crypto rail underneath. The most important name in this story may not be Morgan Stanley, it may be Zero Hash. That sounds strange at first, because the title belongs to Morgan Stanley and E-Trade, but the operating model depends on a specialist infrastructure layer that most retail users may never think about. Zero Hash provides digital asset infrastructure for firms that want to offer crypto trading, custody, settlement, and related services without building the entire crypto stack from scratch. For a brokerage, that matters, because spot crypto is not just another ticker symbol. There are wallet systems, private key risk, trade execution pathways, liquidity sourcing, customer disclosures, tax records, and compliance controls that do not map cleanly onto legacy equities infrastructure. Most headlines skip the friction inside that handoff. A bank or brokerage can own the customer relationship and still outsource the crypto-native rails. That is not weakness by default. In regulated finance, outsourcing specialist infrastructure can be the bridge between doing nothing and building a full internal platform. Bitcoin, Ether, and Solana are the visible assets, but the more valuable asset may be the distribution channel around them. E-Trade has millions of client accounts, and Morgan Stanley acquired that platform to extend its reach across self-directed investing, workplace wealth, and broader retail relationships. Crypto trading fits into that distribution layer because the customer is already there. For years, crypto exchanges benefited from being the place users had to go when they wanted spot crypto exposure. That created a powerful front door. The exchange owned the login, the funding path, the order screen, the balances, the tax forms, and the customer habit. But when crypto appears inside a brokerage account, even through a separate digital asset arrangement underneath, the front door changes. A customer who already uses E-Trade for stocks and ETFs may not care whether the crypto rails are native to Morgan Stanley or powered by Zero Hash. They may only care that the trade is accessible from an environment they already understand. The behavioral shift is subtle. The investor does not need to become more crypto native. The brokerage becomes more crypto accessible. The pressure does not arrive as a headline. It starts with one small user decision repeated across millions of brokerage accounts. It is not that power users instantly leave Coinbase or Kraken. It is that the next wave of mainstream users may never need to arrive there in the first place. They may enter through the same place they already manage equities, cash, options, and retirement-adjacent investing. The 50 basis point fee matters because it gives the story an immediate competitive edge, but it should not be treated as the whole story. A 50 basis point fee means a $10,000 crypto transaction costs $50 before considering any other details of execution or spread. Schwab's announced 75 basis point pricing would be $75 on the same notional amount. For one trade, that gap may not feel enormous. Across millions of accounts and repeated activity, it becomes a pricing signal. Brokerages know this playbook. Stock commissions collapsed because distribution platforms used pricing to acquire and retain customers. Crypto is not the same market, and spot crypto has different operational risks, but the customer psychology rhymes. If a trusted brokerage can provide simple access at a competitive fee, some users will compare that against the friction of opening and funding a separate exchange account. Once the user can see crypto next to stocks and ETFs, the fee becomes more than a transaction cost. The platform can show total performance, provide tax records, display risk exposure, and keep the relationship in one place. That convenience has value even before the crypto product becomes more advanced. The custody detail is where we have to be careful. It would be easy to say Morgan Stanley is custodying crypto for E-Trade clients, but the current structure points to something more precise. E-Trade's materials describe digital asset custody and transactions occurring with zero hash through a separate non-brokerage account, with digital assets not covered by FDIC insurance or SIPC protection. That does not weaken the signal. It clarifies what the signal actually is. It shows how a major financial platform can offer spot crypto access while separating the brokerage relationship from the digital asset custody layer. In plain English, the user enters through E-Trade, but the crypto-specific infrastructure sits underneath with a specialist provider. For institutions, that separation matters. It can isolate operational risk. It can make disclosures cleaner. It can let the brokerage test demand without instantly absorbing every crypto-native responsibility onto its own balance sheet or internal systems. It also gives regulators a clearer map of who does what inside the transaction. A serious analysis has to give the exchanges their strongest case. Coinbase, Kraken, Robinhood, Binance, and other crypto platforms are not suddenly irrelevant because E-Trade added a pilot. Crypto-native platforms still have deeper asset menus, more specialized tools, stronger on-chain connectivity, and communities that want more than basic exposure. For a user who wants a long tail of tokens, wallets, blockchain transfers, stablecoin movement, DeFi pathways, or advanced crypto-native products, a brokerage interface may feel limited. Some users also prefer self-custody or direct control of assets rather than a separated custodial relationship. That audience is not the obvious first target for Morgan Stanley's rollout. The more realistic target is the mainstream investor who wants exposure without learning a new platform. That investor may not want a seed phrase, a hardware wallet, or a deep menu of assets. They may want Bitcoin, Ether, maybe Solana, a clear account view, service support, and tax reporting that fits their existing financial life. The evidence points toward a narrower but stronger conclusion. Banks may capture the easier, more mainstream layer of demand, while exchanges keep the more crypto-native layer. Over time, that split can still matter, because mainstream distribution often becomes the largest pool of casual capital. The timing matters because this kind of rollout looks different after the regulatory environment shifted. In 2025, the SEC rescinded Staff Accounting Bulletin 121 through SAB 122, changing the accounting backdrop that had made crypto custody more burdensome for some regulated firms. The OCC also clarified that national banks and federal savings associations may engage in certain crypto-related activities, including custody and execution services, when conducted safely and soundly. The FDIC separately withdrew its prior expectation that supervised institutions notify the agency before engaging in crypto-related activities. None of this means banks can do whatever they want. It means the environment has moved from blanket hesitation toward conditional permission, risk controls, and clearer supervisory expectations. That shift helps explain why brokerages are moving now instead of years ago. The demand existed earlier, the technology existed earlier. What changed is the willingness of major institutions to connect the demand, the infrastructure provider, and the brokerage interface under a more workable regulatory map. Morgan Stanley's E-Trade rollout does not prove that banks will replace crypto exchanges. It shows something more measured and possibly more durable. Traditional platforms are learning how to absorb the access layer, while crypto infrastructure providers handle the rails underneath. For exchanges, that means the competitive map changes. They may still dominate crypto-native depth, but mainstream distribution is moving closer to banks, brokerages, and wealth platforms. The question to watch is not whether crypto remains separate. It is how much of it becomes invisible inside the financial interfaces people already use. Thanks for watching, and I'll see you in the next deep dive. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.